So now for our next session, we're going to have JP Morgan and Nasdaq speak to you guys about current trends they're seeing in the IPO market and breaking things down from software and life sciences. Without further ado, I'll turn it over to you guys.
Awesome, thanks. I'm Zach Canter, Managing Director in the Software Investment Bank Group at JP Morgan. So it's kind of just an overview of what we're seeing in the equity markets. I think this is probably not a surprise to anyone that's looking at their Yahoo Finance or whatever. Big rebound and stability in 2023 in the markets, broadly speaking, across the Nasdaq, the S&P, technology. Now look, up 26% in technology space off of a down 67% doesn't get you back to square one, obviously. But I think there's a lot of good stuff here. Interest rates, I think that what we're seeing is kind of a leveling off or just kind of a coalescing around where interest rates are going to land. I think from a economic perspective, I think that there's the likelihood of a recession is now less than 50% if you look across all of the analysts that cover the economy. The geopolitical thing, obviously what's going on in the Middle East is complicated to say the least. But I think from a just overall perspective, I think what we've seen here after this major sell-off over the last 2 years is stability. And I think that, it feels like there's a bottom in place and public market investors are sort of more comfortable with the overall investing landscape. And that gives us confidence that, the IPO market is, while it's partially opened over the fall, I think that there's greener pastures ahead in 2024 and 2025. This is half of the slide. So look, this is a slide which we've been maintaining and updating over a number of years, and what you can see is that there were no software IPOs in 2022. Obviously, we've had one software IPO in 2023, and that's Klaviyo, and it's doing reasonably well. I think the question here is, what's it going to look like going forward? I think it's possible we see another IPO, in 2023, possibly, but I think that 2024, I think it's setting up to be a decent year. And I think that there is going to be a return to normalcy. Is it going to look like 2021? No, I don't think it's going to look like 2021 at all. But I do think it's going to look more like 2026, 2027, 2028. I think we're going to see a collection of IPOs. I think that it's going to start with the scaled players that public market investors are. It's going to be easy for them to get comfortable with those companies. And then we'll see how it goes from there. So this is just a look at an evolution of the financial profile of software IPOs over the last handful of years. Obviously, 2023, N equals 1. But what you see is that the size of the companies going public has increased substantially over the last 5 years. What's driving that? I think it's a handful of factors. Partly it's access to private capital, which has become exceedingly, substantially more robust over the last several years. Obviously, in the current market environment, it's a little bit more complicated than that. But large companies have had the benefit of getting even larger in the private domain, which for many companies, it's just a more comfortable environment. You don't have to answer to public market investors on a quarterly basis. So if you can scale as a private company, a lot of companies have chosen to take advantage of that. And as a result, when they do come public, they're bigger. I think growth has continued to be, pretty robust in the 20s consistently throughout the years. But what you've seen is profitability in 2020, anyways, at least ticked up into the positive territory. 2021 was negative, and I think the environment in 2021 was obviously this frenzied environment, and there was a sort of a growth at all cost mentality, and there was this very strong correlation between growth and valuation. I think today, and what you see with, I think Klaviyo is indicative of what investors are looking for, and that's a combination of growth and profitability. You don't necessarily need growth in the 30% range, but I do think investors are much more acutely focused on profitability than they had been in years past. Yeah, so what we're looking at here is just valuations over time segmented by growth. And so what you see is that high growth companies, going back several years, were growing at, were being valued at just nosebleed valuations. And that's indicative of the investor sentiment at the time, which is that there was a growth at all cost mentality. What you see over the last couple of years as the markets have reset is that there's been this sort of compression in terms of how investors are looking at growth versus other metrics. And I think sort of the key takeaway here is that growth alone is not the clearest indication of what a company is worth. And so companies which are high growth but also high burn, investors are taking a much more skeptical view of those types of businesses. And this too is just sort of another look at that point. So segmenting by growth, what you see, I think the key punchline here is if you look at the bottom right-hand part of the slide, the difference between how high growth businesses are valued versus low growth businesses, there was a 37 times delta between where the median high growth business was and where the median low growth business was. And today that's compressed down to 4.5 times. And so what do investors really care about today? They still care about growth, and growth is going to be a major driver of value, but it's not growth alone. They're going to look much more closely at EBITDA margins, at free cash flow margins, at gross profit margins, at unit economics, at the sustainability of your financial profile and how you're growing. If you just have to spend to grow, that's something which public market investors are going to have a really tough time processing. So what do investors look for in a high quality IPO? I don't think this page has really changed, you know, over the years. Maybe growth was further to the left than it is today, kind of in the middle. But they care about market leadership. They care about having a large market to service. They care about your positioning in that market. They want companies which are leaders, companies which have differentiated technology, a differentiated story, a differentiated go-to-market, companies which have a sustainable advantage in the market that they serve, and that they're going to be winners. They care about scale. I think today, probably more so than ever, and you know, as we think about what IPOs are going to look like over the next couple of years, I think companies which are subscale. I mean, I took a company public in 2017 that had $86 million of trailing revenue. I don't think we're going to see companies like that going public today. I just think it's too tough. And also, if you just use kind of a rule of thumb for software companies that you're going to sell 10% of your business in an IPO, if you apply a 10x multiple to that, you're a $1 billion valuation company and you're selling $100 million. If you're trying to target Fidelity, Wellington, T. Rowe, Capital, the large mutual fund complexes, they're candidly not going to get out of bed for $100 million IPO. It's just not worth the work. And so, you know, I think that too is like a major factor which will dissuade companies from going public that are subscale. Growth, as I mentioned, it remains really important. I mean, that's going to be a key differentiator, right? But it's not growth alone. I think predictability is hugely important. Companies which have great visibility, and I mentioned this on the prior panel, the ability to forecast, the ability to know like what your next 12 months, next 24 months are going to look like. In companies which you may be growing at 15%, but you know you're going to grow at 15% for the next decade because that's the setup of the market, that's your positioning in the market. I mean, that's something investors really care about. You don't have to be, you know, growing 60%. I was with a bunch of very large, you know, Boston-based mutual fund companies a month or so ago, and we were talking about AI, which is, you know, obviously a hot button issue. And what they said to me is, look, I wouldn't even know how to value a company growing 250% that, you know, that's doing something where it's changing the market that they service. It's changing faster than we can go through our investment committee process. And so I think for the public markets, companies that are growing like that are so unpredictable, you know, that's not a great fit for how public style investors, you know, think about investing. So, you know, those are some of the key things that investors are caring about. KPIs, I think this is a very important topic. You know, aside from, you know, the actual GAAP financials and non-GAAP financials that you're going to report on, what are the other, you know, KPIs that you want to share with investors, and what are the key things you want to think about when selecting KPIs? And so, you know, what we have at the top, you want to pick the right breadcrumbs, right? You want to pick the things that are germane to your business, that give transparency into your business. The other thing I like to tell, you know, CEOs and CFOs is it's called disclosure. It's not confessional, right? So you want to give things that suit you, and you want to pick things that you're gonna be expected to report on these things going forward, kind of into perpetuity. And so you want things that are sort of future-proof and they're going to age well. You want things that are reliable, i.e. metrics that if you have a good quarter, you want the KPIs that you give to, you know, highlight the fact that you had a good quarter. You don't want to have sort of cross currents in what your KPIs show and what's actually going on with the business. You want KPIs that are easy to understand and ones that aren't too proprietary, right? If you're going through and things which nobody can, they're different from all your comps and the rest of the market. I think that's something which tends to be tough to digest. And also, you want metrics which are easy to produce, that don't require painstaking manual labor in the background to produce them on a quarterly basis. You want things that you can sort of auto-generate out of your systems.
So one thing on the KPIs that a lot of companies will ask as they're private is what KPIs should a private company give out versus what maybe public peers do, but know that once you give out a KPI, you have to keep giving it out. You can't pull back.
So there are certain metrics which you can give on a one-time basis in your IPO prospectus that you're not expected to give on a regular basis going forward. But you're right. It's like giving out a drug to public market investors. Once you give it out, they're going to expect you to keep giving it out. And when you take something away, you're going to make people angry because they want more transparency. And so when you take something away, it tends to piss off your investors.
And making up KPIs like a community adjusted EBITDA, things like that, those don't really work as well as they had in the past.
Totally. Great segue to my next slide. So, yeah. Excuse me. So what are some key metrics that people tend to look at? ARR is a metric which people tend to like. I think in the private markets, people often value companies on an ARR basis. In the public markets, don't see that quite as much. Although for certain businesses, depending upon certain unique business factors, ARR may be a better indicator of scale than revenue, depending upon if you have a non-subscription component of your business or a professional services component of your business, or if you're going through a SaaS transition, which obviously there's a little bit less of that today than there was maybe 10 years ago. Free cash flow, not a GAAP metric, but something which is extremely important. Now, it's also a metric which investors can calculate based on your regular public disclosure, but if there's certain things that you want to highlight, it can be useful to report it on a standalone basis. Rule of 40, that's just, investors are going to macro make that based on your reporting. You don't need to actually give it. Things about unit economics, I think these are very important. Definitely something which investors care about. LTV to CAC, CAC payback, those are things that you can choose to disclose on a one-time basis at the time of IPO. Net retention, everyone's going to ask for it. You basically need to have it. If you don't track it for whatever reason, you should start tracking it. How much of it do you disclose? I mean, obviously, if it's good, you want to disclose it. If it's not good, you may hold it back, but it's something you're going to be bombarded with questions about. And then at the bottom, the customer base, you can kind of choose your own adventure here, but there's lots of little metrics that obviously come out of your systems, thinking about, total customer count, significant customer count. So like customers that pay you over $1 million or over $100,000 or whatever the metric may be. Things like that can be really useful, little breadcrumbs to add some flavor to the financials and the disclosure and the story that you're telling. Oh, that's it.
So we'll make this interactive if there are questions that you can ask, but we're also happy to talk a little more about I know there's a constituent here, cohort of biotech, so we can give you a little more. A lot of these biotechs, it's really just losses. There's no P&L, so it's different metrics to talk about. But we can share with you what we're seeing, on the biotech side.
Any questions before we get started?
May I? Okay, I'll try to speak louder. Could you list maybe like 2 or 3 indicators? Why do you believe that 2024 market going to be better than now? Like, what makes you believe?
Can't get worse.
Yeah, won't get worse. Thank you.
Yeah, no, it's a totally legitimate question. I think what I'm seeing from clients is, there's some mobilization going on, which indicates to me that there's going to be IPOs, but that's not really your question. Your question is like, but why? I think part of it is just time, right? I mean, there are companies in the private market which I think they have the scale, the financial profile to go public. Sure, it's not 2021, but I think that there is a recognition that 2021 is not coming back. We're not going to see the Coupas of the world trading at 28 times revenue. It's just that's not going to be the environment going forward. And I think that the longer we kind of live in the current valuation environment, I think the more that it coalesces, this is the new reality, and companies get comfortable with that, and they're like, we want to go public for all of the reasons companies want to go public. We want the branding opportunity, we want liquidity for our employees. The time is now, and we're accepting of the current valuation environment, and we want to go. So I think that I think there's just this sort of groundswell that's going to get some companies out. There are companies which would have gone public in 2021 that are not going to go public in 2024, for sure.
No, I think that's right. And to give you some real data points from the conversations that we're having with private companies, that they're willing to take the medicine. They're going to take a reasonable valuation. And in some companies, it's more painful than others. There's ratchets. There's all kinds of implications to going out when you've raised at a higher round. So those are hard conversations to have. But at some point, you need to raise money. You can only put your money into treasuries for so long and fire people before the cash runway, ends. So that's coming. It's not there yet, but it's going to be there next year. And those companies are aware of it, and they're thinking thoughtfully about how they're going to raise capital and what they're going to do. And to your point, it's not going to be, I think on average, we're looking at, 200, 150 IPOs a year. Maybe we hit 300 plus operating companies in '01. It's not going to be 300. It's not going to be 50, but it's going to be somewhere in the middle. And those companies are going to be those higher KPI companies. The bankers are going to bring the better quality companies to the market first. Those are the ones that will perform the best. And as long as they're willing to have that reasonable valuation conversation, which it sounds like it's starting to happen, then you're going to see the activity start to percolate.
And I think just speaking generally is that there's the expectation that the first 8 months of next year will be very busy. Being an election year, there's the expectation that not a lot of companies are going to be looking to launch during the fall timeframe based on the volatility that's expected during the election year. So we've seen a large number of companies start preparing for some type of IPO or crossover into an IPO process in the first half of next year. And I can speak more specifically about the biotech side.
Yeah, and we can telegraph too, because you see if you want to go public in April of next year, you need to start working now, right? So you can start to tell who's doing their homework and who's orging up and having those discussions. Whether they actually go or not, that's another conversation. But the companies that we're working with are looking for that window. They think there will be an opportunity for them, and that gives us hope in what we're seeing on the conversation level today.
And I think there was a pickup in the summer when it felt like there was more market recovery, that companies started dusting off their S1s that were on the shelf before, that's been on the shelf for 18 months, 2 years, and started reorging up, starting their drafting process again, starting TTW process with investors to target end of year window or first half of 2024. I think within the biotech market specifically, and I can go into this, is that over the last 6 weeks, we've seen obviously more volatility, more deterioration in that market. So that's pushing out some of those timeframes, but a large number of companies are getting prepared for 2024, either through orging up or just starting the process.
And it very much will be a sector story too. So this is not a one size fits all. Biotech, biopharma, short-term investors are 5 years, long-term are 10-year plus. So they're not really focused on next year's Fed fund rate. They're focused on data readouts, and clinical outcomes. So that's a whole separate conversation. If you're talking about clean technology, energy transition, that's a separate bucket. Enterprise SaaS, totally another bucket. So we're starting to see these green shoots in certain verticals, but it's definitely not open for all.
I would also add that if I put my finger in the air, I think for what it's worth, I expect 2025, which is a long way out, to be busier from an software IPO perspective than 2024.
Thank you.
All right, I'm gonna go ahead. I can't read as well as Zach off of the wall, so I'm gonna step down just because my eyesight's worse. So I think one thing I just wanted to ground everyone in just before getting into the IPO market specifically is just the general biopharma market landscape and how that has performed over the last 18 months. So healthcare and large pharma was a defensive play for many generalist investors in 2022. That has gone away in 2023 as the market has started to rebound a little bit. There's more investment in tech and an aversion to the large pharma and biotech. I think within the large pharma market, we've seen two players stand out, Novo and Lilly, and that's due to the growth of the type 2 diabetes and obesity markets. I think, as Zach was mentioning, we're seeing a strong correlation to valuation to growth, consistent in the large pharma market, similar to the tech market. And more generally, as you think about mid-cap companies, investors are targeting those companies that have near-term catalysts. So companies with real clinical data, near-term catalysts, an aversion to those type of platform technology stories that are 12 to 24 months from being in the clinic or producing a data set that they can provide some validation of the technology platform that they're buying into. Within large pharma as well, I think there's been a better understanding over the course of this year regarding the loss of exclusivity periods for many of these companies. Many of those companies have big patent cliffs coming up at the end of the decade that's driving a lot of the acquisition activity in the space. But it feels like we've gotten a better hold of that through some of the internal pipeline developments at these companies, as well as through some of their external BD. I mean, case specific at each of those large pharmas, but we're starting to get a better handle of who's in a better position come LOE period at the end of the decade. And I think we've also gotten a better handle of the Inflation Reduction Act. I mean, we've seen a number of these large pharmas file lawsuits against the government with respect to the IRA. I think many of those companies have an idea of which products are going to be ring-fenced going forward. There's still we're seeing it still play out at large pharma because they're making, and they've indicated to the market how they're making investment decisions across their portfolios based on small molecules versus antibodies. And you've seen, and it's difficult to tell how large pharma is really thinking about it though, because for instance, the Lilly CEO came out saying he's worried about the Inflation Reduction Act, oral small molecules, and then the week later he buys Dice. So, you don't really know how they're playing it. Some of it's for political reasons, but I think there's more to come there. Just with respect to public companies, what we saw in 2021, 2022 is that companies who had positive catalysts weren't being rewarded from a stock price perspective, which inhibited their ability to raise capital on the back of that data. Since that time, over the last 12 to 18 months, last 12 months, we've seen better market reaction to positive data. I mean, we're still in a market in which mixed data sets will trade off and poor data sets will certainly trade off. But to the extent a company produces a strong data set, we're getting positive market reactions. Companies have the ability to finance on the back of that, indicating that it's a healthy and strong market. I mean, it's difficult to talk about the public market today without talking about the financing overhang. I mean, I think people generally categorize the public markets today as the haves and the have-nots, those that have the ability to raise additional capital to see their value inflection points through pipeline development, and those who are struggling to get there, those who are reprioritizing their pipeline, restructuring their workforce, those who are trading below cash. You can see here just the number of public companies trading below cash. It's about 36%, but almost 57% are trading below $100 million in firm value.
Well, one thing about, so we have a lot of companies on Nasdaq that are biotechs that trade below cash, but a lot of those companies got themselves into this position because they have no data to defend for the next year and a half that they're waiting on. So going back to the earlier panel where you talk about these companies and why they have these investors are looking for clinical data within 6 to 8 months or 12 months of an IPO, it's because they want to have something to know what they're invested in. If you're just sitting around for 2 years trying to defend a valuation story with no data, it's a challenge versus growing into your valuation, which is kind of what the market is set at today.
Yeah, and that goes into our earlier panel in terms of what are the options for these companies that are struggling from a cash perspective. Some are folding up and starting processes for reverse merger in which they're looking to find partners there. Others are looking to partner or collaborate with large pharma. I mean, that's difficult and time consuming. So they may run out of cash by the time in which a partnership is able to be consummated. But they're pursuing all options. They're pursuing rescue financing. They're talking to royalty pharma players. So it's, all options are on the table for some of these companies that are just struggling to make it to the next catalyst. I think Zach covered the macro landscape pretty well. Just a couple of notes here. Just some of the, some of the economic data that's been produced, including the CPI data that came out last week. was encouraging for those bull type investors who believe that there's going to be a soft landing, that there's going to be a return to growth, there's going to be a positive equity market, in towards year end heading into 2024. I mean, I think there's still a 50-50 chance, or our economists are indicating that there's a 50-50 chance for another rate hike this year. So, with the Fed message of higher for longer, which is obviously difficult for biotech and tech companies who are being valued on a net present value basis, so a higher discount rate equals a lower valuation. It's a difficult environment, and then coupled with the geopolitical concerns that only increases the volatility that we've already seen, just kind of exacerbates the current market environment. I mean, I think just touching on some of the market barometers that we've seen, and I'd say that, as mentioned before, that over the summer we saw those green shoots of optimism, and really from the biotech market side, over the last 6 weeks, we've really seen that deteriorate. I think, we headed into Labor Day hoping that there was going to be a strong calendar of financings, both from a follow-on perspective as well as from an IPO perspective. We've seen 2 IPOs price since Labor Day. There's one in the market this week and an additional one on file. But we were expecting more from an IPO perspective heading into this point of the year. And maybe just a point before we get specifically onto IPOs within the biotech market is that the mix and cost of capital just have continued to evolve here. As mentioned, the kind of the strategies that public companies are employing in order to fund themselves, it's just raising the cost of capital in this environment. Focusing specifically on the biotech market, the IPO market, it's obviously open and receptive for high quality issuers. I think the one thing that we're speaking with companies and boards about is how do you, if you're considering an IPO, what do you define as a successful IPO? I think it's key and it's different for each company. I mean, generally we say it's, you're trying to ensure in a reasonable valuation for the company, achieve a strong aftermarket performance. You're able to raise the funds that are necessary to fund the company through your inflection points, and you bring in new investors into your story. Those are kind of the 4 key tenets of it. But within those tenets, I'd say some boards favor certain aspects over the other. Some boards may favor a higher valuation. They're more worried about dilution, and they're looking to achieve the highest valuation in the market, less concerned about aftermarket performance. They believe that the story will play out over the next 12 to 24 months, and they'd rather get a higher valuation today. But I think for the most part, we aim to align ourselves with boards to kind of achieve those 4 things in tandem. I'd also say that the criteria for IPO issuers within the biotech market has shifted from 2020 to 2021 to today. Typically, we're looking at clinical stage companies with data sets that investors can dig into, can do their diligence on. Near-term catalysts, as mentioned before, 6 to 12 months out from the time of IPO. You'd want to have a cash balance that at least funds you through the next 12 months at the time of IPO before your use of proceeds. So those are some of the key points. I mean, and then obviously what's consistent today, which was consistent then, is having 100% insider support at the time of launch. That is just the backbone, and now is just customary within this market that there's a bought deal.
Yeah, no, I mean, if you go back far enough into the SEC filings, they used to actually write on the cover on the first page that the commitment from the insiders to show strength of deal. That's not on. We haven't reached that point yet, but it's there. It's a shadow book. Every deal is expected to be 1 times covered. There are some subsectors within biotech which are getting more attention than others. It's everything in diabetes, weight loss, GLP-1s, I&I, radiopharma. That's where you'll see a lot of the short-term IPO activity. But what's interesting about this turn, knowing all these deals are covered, everything that flips over, there's a survivorship bias, right? You're not going to flip your S1 until you're fully supported, fully covered, and you're going to have a successful outcome on the roadshow. So what you're seeing for those deals that actually flip over is a lot of interest and a lot of demand. And the number of sellers in these books is actually very small. Our biggest challenge on the IPO day is finding sellers to get the stock to open with enough of a float and liquidity to make sure that it's paired properly. So you think about all the insiders, they're buying more, locked up, they're not selling. So there's a very small percentage of shares actually trading on these IPOs, and that share constraint can also swing volatility more. So it's becoming this little bit of a chicken and egg problem, what we see on the opening day, but you don't judge these deals on day one performance. It's really based on the data flips and those milestones that are going to be transformational inflection points on the business from a catalyst standpoint. That being said, all of the companies that have gone out recently have been spending way more time with investors leading up to the IPO than I think any biotech trend in the last 3 years. So 70 plus TTW meetings before they actually go out on the road. I don't know when the last time you saw a company do 70 TTW meetings, but all of that work, that legwork, is being done 12 months before the IPO. And so if you're meeting an investor on the roadshow for the first time, that's a really bad sign. And the companies that do this well are going to have even better outcomes on their IPO.
Yeah, 2 to 3 years ago, they were doing about 40 testing the water meetings, and now it's somewhere 70 to 100. There was an IPO that we did last year that was over 100 testing the water meetings. It's just kind of necessary in this environment, especially for those companies that are looking to achieve a higher valuation. Just pointing to a couple of statistics on this slide, you can see the volumes here just in the upper left. In 2021, about 14.8 billion of volume versus 2.2 billion so far this year. From an IPO valuation perspective, it's a little bit difficult to look at on the top right here. It looks about consistent with 2021, but a much lower end for 2023 versus 2021. Step-ups of about 1.4 versus 1.6 in 2021. I think that's we're seeing 1.4 versus 1.2 versus last year is it's really just a reflection of more companies being realistic with their valuations today. Many of these companies have taken down rounds or as they saw a crossover round, didn't try to push on valuation and wanted to be able to be in a position in which they could launch and achieve a step up for those crossover investors. And
most of those step-ups, though, now are based on data-driven step-ups versus financing step-ups. It's just because you raised money and you're raising again doesn't mean you can just step up for no reason. So I think that scrutiny is back, where in the past it necessarily wasn't the case, but a lot of these step-ups are validated by some past data readout.
Yeah, and you can just in the middle of the right-hand side, you can see just the mix by stage of development from 2021 to today. So today it's phase 1, 2, and phase 3 companies that are going public. And aftermarket performance for these companies are still challenged. 67% of the companies that have IPO'd this year are trading below issue. And you can see that on the right-hand side, 80% in 2022 are trading below issue and 88% in 2021. So still a difficult environment for the IPO asset class, but there are certain winners, for instance, Raise Bio, which was an IPO that JP Morgan led, that priced last month. And Jordan touched on it. It's in the radiopharma space, so the scarcity value, they were reasonable with respect to the valuations. They had a lot of testing the water meetings. They made broad outreach to investors. They wanted to bring in a lot of high quality new investors into the story. And within the radiopharma space, there was a market precedent with Novartis's acquisition of AAA, Lutathera. People could point to that. So there was many things that helped that story, and then, you can point to other companies that have gone public this year that have traded off since the time of IPO. Some is downward pressure as a result of going after a higher valuation. So.
I would also say, though, of all the IPOs in the biopharma space that went public this year, 100% of them priced within the range. So what that tells me, and you look at all the aftermarket performances, the deals are reasonably priced, and there's support around the valuation and the range of the offering. But to the aftermarket performance point, it's going to be a challenge, and you better be thinking about how you're going to communicate that strategy to the investment side, and also what that catalyst date for the inflection point is, because if it's in 6 months, that's a very different conversation with investors versus 12 months plus.
And just being cognizant of time here, I think the one additional point, and we won't get to all the slides here, is this. The M&A component as part of the IPO process, it still holds true that investors will want to believe that there's an M&A takeout story for these companies that are going public. Jordan touched on the makeup of some of those companies by therapeutic area that have gone public within the I&I cardiometabolic space. If you look at the acquisitions over the course of this year, that's greater than 50% of the deals done. So, you know, there's a clear bias from both large pharma and investors within I&I and cardiometabolic just this year, as opposed to prior years.
Pause. Any questions from the audience?
I have a question. It's a little digression, but I was trying to figure out, like, what have been the IPO activities in renewable energy sector and technology sector, you know, apart from biotech and software?
So is it more about the mix of the sectors that we're seeing today versus what? I think it's just there's clearly a demand being created around these little moats, and I think the software space is always going to be an interesting. When I think of true innovation, investors want to invest in innovation. It's either really enterprise software to some extent and biotech. You're seeing innovation happening in clean tech and energy transition, and that's exciting. But from deploying capital into pure innovation, that's where you're seeing the reward in the public markets, I think. And that's what's driving a lot of these sectors and creating, you know, I think just having an e-commerce business, we'll pick on the consumer space today. You know, you look at the performance of Birkenstocks, and my favorite quote was it stubbed its toe, and now my take is it looks like the toe's infected. Just levering up a business and not innovating and selling it off so the sponsors make $1 billion is not necessarily going to give you the best outcome in today's market versus a truly transformative biopharma company or someone who's doing something, you know, in clean tech that's really revolutionary. Those companies are standing out a lot more than they have in the past.
Could you just expand a little bit about what you mean about the impact of the M&A process prior to an IPO? I mean, most biotech companies need to have pipeline. So how can KPMG's deal advisory group participate in that process to help everyone in this room if they're looking for bolt-on acquisitions a year or two before the IPO process?
I mean, so I spoke about this before, but I mean, many of the boards are considering dual track processes for these companies that are looking to IPO. I think the one thing that's difficult is mapping up those timelines from a large pharma perspective versus the IPO timeline. So trying to confine it within those 4 to 6 months. Large pharma has tons of capital today that they're able to deploy. I'd say the one thing is that they're being disciplined and they're income statement constrained. So they'd rather not put it on their balance sheet because they'll have to make portfolio optimization decisions that they may not want to do in the near term. So those are some of the considerations we're seeing. I mean, but I think that going into 2024, we're going to see the M&A market for biotech companies continue to grow. But large pharma has the ability to wait, and they'd rather wait until an asset is de-risked until they really buy into it. So that's going to be a continuing trend.
All right. Yeah, I think that's the hook. we could probably pepper you guys with questions till 5 o'clock, but I think to stick with our schedule, thank you guys all for, I don't know if there's any parting points, but. And again, I think most of our speakers will be muddling around at lunchtime, so feel free to pepper them with questions.
I'll just leave you guys with one last point. We're all here to help prospective clients go through the process. So leverage the advice, reach out to us. If you have questions, we're more than happy to share our perspectives, absorb as much information as you can, because the more you learn about the dynamics and how this is changing, I think it'll help lead to better outcomes. So I'm going to offer up the JP Morgan team. I'm also available, but if you ever want questions, feel free to reach out to us.
Yeah, I would just expand upon that. The IPO process can feel like a very, Byzantine maze that you're wandering through. And it's our job to help. This is what we do on a daily basis, obviously less so in the last 18 months, but we live and breathe this stuff, and it is really complicated and mystifying, and we're here to help. And so, we welcome the opportunity to continue the dialogue with everyone.
I just echo that. I mean, we're still being active in the market. It's just you're seeing less deals get done, but we're still talking to a lot of companies today about how to plan for an IPO, how to think about timelines for an IPO. So ongoing discussions that we're still having on a day-to-day basis.
That just gives you more time for that IPO readiness that we were talking about earlier, right? All right, thanks, gentlemen.